Part 1. The costly mistake of waiting to start. I've been investing for over 70 years. In that time, I've seen thousands of smart, educated, well-meaning people make the same mistakes again and again. And the surprising thing? These mistakes aren't complicated. They're simple, avoidable, and incredibly expensive. We're talking hundreds of thousands, sometimes millions, lost over a lifetime just because someone didn't know better. The first and most expensive mistake is waiting too long to start investing. Beginners often think, I'll start when I know more, when I have more money, when I'm ready. The problem is, while you wait, the most valuable resource you have, time, is slipping away. I see it all the time. Someone in their 20s says, I'll start at 30. At 30, they say, I'll start when I earn more. At 40, I'll start after paying off debt. And suddenly, at 50, they have nothing saved. Here's why starting early is crucial. Money invested in your 20s grows exponentially more than the same amount invested in your 40s or 50s. Why? Compound interest. Let me show you the math. Invest $5,000 a year at age 25 with a 10% annual return by 65, you'll have $2.4 million. Invest $5,000 a year starting at 35 by 65, you'll have $900,000. That's $1.5 million lost just by waiting 10 years. The solution is simple. Start now. Even if it's just $50 a month. Even if you don't understand everything. Open a brokerage account, buy an S&P 500 index fund, and begin. You'll learn as you go, but starting early gives compound interest the time it needs to work. When I started investing at 11, I didn't know everything. I made mistakes, but starting early was a huge advantage. Time in the market beats timing the market. Part 2. Avoiding risky stock choices and market timing. The second mistake beginners make is buying individual stocks without research. They hear a hot tip from a friend, read a trending article, or see a social media post and jump in blindly. They hear a hot tip from a friend, read a trending article, or see a social media post and jump in blindly. That's not investing, that's gambling. The key to success is understanding what you own. Before investing in a stock, ask, do I understand this company? Can I explain why this stock is worth its price? If the answer is no, don't buy. Most beginners shouldn't even pick individual stocks. The simpler, safer alternative is index funds. A total market or S&P 500 index fund instantly diversifies your investment across hundreds of companies. No stock picking required. Stick to what you understand or use index funds. That's mistake number 2, avoiding research. The third mistake is trying to time the market. Beginners think they can buy at the bottom and sell at the top. They can't. Nobody can, neither me, nor the smartest Wall Street investors, nor computer algorithms. Here's what usually happens. The market rises, they wait for a dip, miss gains, panic during a crash, sell low, and regret it later. The solution? Invest consistently. Same amount every month, regardless of market conditions. This is called dollar cost averaging. It reduces risk and ensures long-term growth. Remember, time the market beats timing the market. Part 3. Staying calm during crashes and diversifying. Mistake 4. Panicking during market crashes. Markets crash regularly, 20%, 30%, sometimes 50%. Beginners often sell everything to protect their money. This locks in losses and prevents you from benefiting from the eventual recovery. I've lived through every major crash, 1973 to 74, Black Monday 1987, dot-com bust, 2008 financial crisis, and even COVID in 2020. During every crash, I stayed calm and held my positions. Often, I bought more. Crashes are opportunities to buy great businesses at low prices. Here's how to avoid panic selling. 1. Accept market volatility as normal. 2. Don't check your portfolio daily. Long-term investing is about decades, not days. 3. Remember history. Markets always recover. Mistake 5. Not diversifying. Putting all your money in one stock or sector is a disaster waiting to happen. If that single stock crashes, you could lose everything. Diversification reduces risk without lowering potential returns. At minimum, Own 10 to 15 stocks across sectors, or simply invest in an index fund for automatic diversification. Don't over-concentrate in your employer's stock. Protect yourself. Part 4. Fees, past performance, and planning. Mistake 6. Paying too much in fees. High fees silently destroy wealth. Example: $100,000 invested at 8% for 30 years without fees. $1,006,000. With 1% annual fees, $769,000. That's $237,000 lost to fees alone. Avoid this by 1. Using low-cost index funds, 0.03 to 0.05% expense ratio. 2. Avoiding high-fee financial advisors. Opt for fee-only advisors if necessary. Mistake 7. Chasing past performance. Investors often buy last year's winners, assuming they'll keep growing. Markets are cyclical. Past performance does not predict the future. Focus on value, not trends. Mistake 8. Investing without a plan. Many people invest emotionally, chasing trends or selling in fear. This is a recipe for failure. A proper plan answers: what am I investing for? Retirement? House? Education? How much will I invest regularly? What will I invest in? 70% total stock market, 20% international, 10% bonds is simple and diversified. When will I rebalance? Under what conditions will I sell? Write this plan down. Follow it consistently. Discipline beats emotion every time. Part 5. Action plan to build wealth. Let's recap the 8 mistakes and how to avoid them. 1. Waiting too long. Start immediately. 2. Buying stocks without research. Use index funds or invest only in what you understand. 3. Timing the market. Invest consistently regardless of market conditions. 4. Panic selling. Expect volatility and trust history. 5. Not diversifying. Own multiple stocks or index funds. 6. Paying high fees. Use low-cost index funds. 7. Chasing past performance. Focus on fundamentals, not trends. 8. No plan. Create a written investment plan and stick to it. Here's your immediate action plan. Open a brokerage account today. Set up automatic monthly investments. Invest in a simple portfolio of index funds, 70% U.S. stocks, 20% international, 10% bonds. Commit to never selling out of fear. Check your portfolio quarterly or yearly. Rebalance annually. Educate yourself gradually. Read books like The Intelligent Investor and follow Berkshire Hathaway letters. Ignore hot tips and trends. Stick to your plan. Investing consistently, diversifying, and avoiding emotional decisions is the key to building wealth. It's not exciting, it's not glamorous, but it works. I've followed this strategy for 70 years. The people who succeed aren't those trying to be clever. They're disciplined, patient, and focused on long-term growth. You could do it too. You don't need to be a genius. You don't need luck. Avoid these 8 mistakes. Stick to your plan, and let time and discipline do the rest. Start today, and your future self will thank you. Part 6. The mindset that turns knowledge into wealth. All the strategies I've shared, the 8 mistakes to avoid, the importance of starting early, diversification, low fees, consistency, are crucial. But there's one element that separates those who succeed from those who fail, and it's often overlooked: mindset. Even with the perfect plan, without the right mindset, your investments can falter. Most beginners make one fatal mental error. They let emotions run the show. Fear, greed, and impatience destroy wealth faster than bad stock picks ever could. Think about it. The stock market will fluctuate. Some years, your portfolio may drop 20%, 30%, even 50%. If you panic during those times, all the planning in the world won't save you. Conversely, if you get greedy during booms and chase every hot stock, you'll overpay and risk massive losses. The solution is simple, but not easy. Develop emotional discipline. This isn't just about controlling impulses. It's about training your mind to see the long-term picture. Here's how to cultivate the mindset of a successful investor. 1. Focus on the long term. Think in decades. not days or months. Each decision should be evaluated in the context of your 20 or 30-year horizon. A temporary drop in your portfolio is meaningless if your investments are fundamentally strong. 2. Embrace volatility as opportunity. Every market dip is a chance to buy quality assets at a discount. When others are panicking, you can become strategic. This mindset requires patience and courage, but it compounds wealth faster than short-term trading ever could. 3. Detach from winning and losing labels. Stop obsessing over daily gains or losses. Instead, measure your success by whether you're following your plan and making progress toward your goals. This mental shift keeps you calm and focused. 4. Develop curiosity, not fear. Learn constantly. Study companies, understand markets, read financial statements. The more informed you are, the less likely you are to make decisions out of fear or hype. Knowledge reduces anxiety and increases confidence. 5. Practice gratitude for time and compounding. Every month you invest is a gift. Every year you stay invested, compound interest multiplies your wealth. Appreciate the advantage of starting early and remain patient. Wealth grows quietly and steadily. Celebrating small wins keeps you motivated. 6. Be stubborn about your principles, flexible about strategies. Stick to timeless principles. Invest in what you understand, diversify, avoid high fees, and follow your plan. But be willing to adapt tactics as circumstances change. Markets evolve, industries change, but the fundamentals endure. I've seen investors lose millions not because they picked bad stocks, but because they reacted emotionally. Panic selling, chasing trends, and constantly changing strategies is a guaranteed way to fail. Wealth comes to those who stay consistent, disciplined, and calm, even in chaos. Turning knowledge into action. Now that you understand the mindset, the next step is translating knowledge into action. Too many beginners read articles, watch videos, and nod along, thinking, I'll do it tomorrow. But tomorrow never comes. The wealthiest investors take immediate action. Here's your step-by-step mindset plus action framework. 1. Commit to starting immediately. Open your brokerage account today. Even $50 per month counts. Time is your superpower. Don't waste it. 2. Automate your investments. Remove the emotional decision-making. Set up automatic contributions so investing happens consistently, regardless of how you feel about the market. 3. Follow your written plan religiously. Your plan is your shield against panic and greed. Refer to it when headlines tempt you to make impulsive moves. 4. Educate while you invest. Reading about investing is not a replacement for action. Learn continuously, but implement gradually. Start small. Grow your contributions as your understanding deepens. 5. Celebrate discipline, not short-term gains. Every month you invest without deviation. Every year you resist panic selling. Every time you follow your plan. These are the real victories. Wealth accumulates quietly. 6. Mentally prepare for setbacks. Accept that losses, volatility, and mistakes will happen. They are part of the process. Use them as lessons, not reasons to quit.